for the very warm welcome, and certainly on behalf of everyone at ABC, both Bullion and the refinery, echo your sentiments, and thanks to Kerry for putting on another great event and giving us an opportunity to be involved. It's been many years that we have been, and we're delighted to be here. So the topic of the conversation over the next 30 minutes, as Jess alluded to, going to talk about the Fed. Everyone thinks rate cuts are coming. US election, which is scheduled for a couple of months from now, and how these things are going to impact gold, or may well impact gold in the year ahead or so. But the way I sort of wanted to structure the talk was really to first start by looking at what has happened really in the last year, so almost to the day since this conference was held 12 months ago. What's transpired in the 12 months since, where the market sits today, and then we'll get into some of these sort of future drivers of gold. And the reason I wanted to do that, I was actually looking at last year's presentation before, as part of preparation for this talk, and I thought, wow, it really was an incredibly decisive moment in the gold market 12 months ago. A lot of us may have forgotten it now just because, you know, the passage of time and how much, you know, I guess news and things just bombard us every day. But if you look at where we were 12 months ago, we're at this incredibly important point where gold had 3 times in the space of about 18 months pushed up against this USD $2,000 price point. The chart you're looking at, US dollar gold price goes back to 1999, and so you can sort of see, you know, almost 13 years ago, or about 13 years ago exactly, in 2011, you know, gold had that first run which proved to be unsustainable. It got just above $1,900. Most people in the gold industry were incredibly exuberant back then. I think SPDR, the largest gold ETF in the world, was in fact the largest ETF full stop. It was bigger than any equity ETF, bigger than any fixed income ETF, bigger than any broader commodity ETF. There was this huge appetite and inflows into gold that had transpired in the aftermath of the global financial crisis, the first iterations of QE and zero interest rates. Obviously, that marked a sort of cyclical top. We went into this sort of 3-year corrective period, and then gold started to pick up again from 2016 onward, which obviously coincided with Brexit and the first time Trump ran for office. Then we had this period where gold got up to around the $2,000 mark. It had 3 goes at trying to get above it, and a lot of people in the market thought that it just didn't have the legs, right? So it took a long time for gold to actually push through this $2,000 price point. But as we all know, it has gone on to do that. And most, I'd say, market observers, those that follow gold quite closely, were pretty confident that it was going to be a case of, I suppose, 5th time lucky, as it were. And one of the primary reasons for that was that unlike 2011, and definitely unlike 2020 when we were all dealing with COVID, no one actually cared about gold 12 months ago. And one of the best ways of visualizing that is this really simple chart, which again, I actually used last year, but I still think it's relevant. The white lines on the chart just show, it's just a count of the number of stories that Bloomberg track that mentioned gold or dealt with gold in any given way. And there's an overlay, the red line is the gold price. So if you go back to 2013, there was like 90,000 stories a month, a news article, a financial headline, just something that talked about gold at all, right? You can then see what happened in middle to late 2020, and then in early 2022, when the Russia-Ukraine war started, gold was very, very topical. But by August of last year, almost no one was talking about it, even though gold was again knocking on the door of $2,000. And then if you look at the sort of more broader backdrop and where gold sat 12 months ago compared to where it had at other periods where it was around this price point, the I suppose broader market environment could not have been any more different. So again, just as a summary of where we've been and where we might be going, back in 2011, which proved to be, you know, effectively a 10-year roadblock for gold, we just couldn't get above that $2,000 point back then. But in 2011, gold had been in a 10-year bull market. By 2023, gold had basically spent 10 years treading water. In the 10 years to 2011, gold had had this huge outperformance versus equities. In the 10 years to August of last year, it had actually substantially underperformed, given the S&P 500, mostly led by tech, had performed as well as it had. there were these huge market tailwinds for gold in 2011. You had QE, you had zero interest rates. By the middle of last year, you actually had the Fed was tightening policy, nowhere near the kind of, I suppose, monetary stimulus that was being deployed into the market. You also had a completely different outlook or a completely different layout for speculative positioning. So, some people aren't huge fans of the gold futures market. Personally, I think they add liquidity and they're just another avenue for people to access gold, and they're very important for other parts of the market in terms of hedging risk and running their operations. 2011, huge speculative positioning, people gambling that the gold price would go up. By the middle of last year, was pretty non-existent. And then the other main point was what was happening in the ETF space. So as I mentioned earlier, in 2011, SPDR was the biggest ETF full stop in the world, not only the biggest gold ETF, and there were huge inflows into those products. By the middle of last year, you'd seen substantial outflows, and in fact, that part of the market is only just starting to turn today. So that sort of helps explain, I suppose, why the backdrop that allowed gold to sort of go on and push above this $2,000 price point, and very decisively. We're obviously sitting here now, or in August 2024, the price is basically the better part of 25% higher if we sort of use a $2,500 price point in US dollar terms. But in terms of what has taken place in the last 12 months, obviously you've seen that spike in the gold price, as I say, circa 25%. The performance has basically been matched by silver. But silver has not outperformed to the upside yet, which it typically does when you're in a fully fledged precious metal bull market. The other thing that has happened is that risk assets, and I'll sort of throw crypto in there, but I think equities are the more important one to look at. Risk assets have also substantially rallied in the last 12 months. So if you were to look at the ratio between the gold and the S&P 500, even though gold's up 25%, the ratio hasn't budged because equities are up as well. And I think that's important because what you tend to see is, from a demand point of view, the price of gold is one thing, but the demand really only comes when people are feeling pain in other parts of their portfolio, which is another way of saying when the equity market has a substantial fall. So I used to work in traditional asset management up until basically 2010. I'd been a gold investor since about 2003, so I was incredibly fortunate with my own portfolio. But in my time in traditional asset management, from about 2003 to really to the time I left, I was always sort of talking up the role of gold. It could play in portfolios, you name it. Absolutely no one cared until the global financial crisis hit. And the reason was they weren't feeling any pain because, yeah, gold was doing well, but so was equities, right? So it's not until you feel a little bit of hurt do you get that motivation to move your portfolio. And we're still not really seeing that in the market yet, as I say, largely because equities have still been as strong as they have. And that really sort of flows through to what we're seeing both at the retail bar and coin demand. It's more subdued than it was 2 or 3 years ago. It's not by no means terrible, but it's not gangbusters like it was. The ETF market for gold, as I said before, is still pretty slow. It's actually been mostly outflows for the last 4 years. It's just started to turn now, which is a good sign because you actually need money coming into those products to help push gold prices higher. And obviously the standout from a positive demand side of the gold story has been this just extraordinary level of central bank demand that it dates back to the GFC in terms of when it started, but it has only gotten extra legs up due to the broader geopolitical environment that we're operating in, which I know a lot of other people have spoken about in the last day and a half. So if you were to summarise what has happened in the 12 months since we last convened here, the price has obviously performed exceptionally well. So from that perspective, you could kind of say the market is firing, but absolutely not on all cylinders, right? There are multiple legs that can still come into play to support the gold market and the silver market as well. So what happens next? This is where we get into our crystal ball phase. And the 3 elements that I wanted to talk about were the presidential election, the shift to monetary easing, and then really the potential for gold to really come back to the fore as a hedge against potential equity market risk. Bit of a shout out to the World Gold Council here, who wrote I thought a really, really balanced and sober piece on the US election and the potential outlook for gold. And as much as I think a lot of us would love to say the election is going to be a sort of pivotal market event, history suggests that is probably not the case, right? So this chart that they included in their research just showed the sort of the first thing you can see of here. Oh, I should use the laser. There we go. That thing there, that shows the average return for gold in any 6-month period. It's just under 5%, which makes sense if you think 9 to 10% annualised. And then these other, I suppose, circles that you can see on the chart show the average performance for gold in the 6 months leading into an election, the 6 months after an election, and then there's a breakdown depending on whether Democrats or Republicans get into office. And what you can kind of see is that actually in the sort of, oh, whoops, hang on, how do we go back? There we go. What you can actually see is traditionally, or at least over the last 50 odd years, gold has tended to kind of not do that much in the 6 months before an election or the 6 months after. There's a little bit of a tilt that if a Republican wins, it tends to be a little bit stronger going into office and then a little bit more subdued afterwards. Actually, what happened the first time Trump won was an example of that. Most people thought if Trump wins, the gold price is going to soar. I don't know how many people remember that election night. I remember it very, very closely. It had a spike up when he was very clear he was going to win office, and then it actually fell away quite substantially just for a short period of time, but it actually did sell off a little bit. So the 50 years of data, and of course the next time can be different, suggests that elections haven't typically been a major market event, or gold hasn't necessarily moved after the election is run. So they had some other comments on, this is a picture from the last time that I was at a presidential party. That was the Trump v Hillary one. That was down in Sydney. Hillary was looking happy. I don't think the results had come in yet. But just got it now, Jess. Yeah. Anyway, whilst the election itself may not be a major driver, clearly there are some geopolitical risks that are very, very prevalent right now. I think what happened in the Middle East over the weekend is a classic example of that. And really, gold is going to continue to be driven by other things, by central bank demand, by what happens with the dollar, by what happens with rates, by what happens with equities, which I'll get to as well. And that sort of dovetails on to, actually, sorry, one more point I wanted to make about this, which I think is actually very interesting, is that whilst the election may not matter for the gold price, World Gold Council's data, again, suggests that it may well matter for the gold industry. So what this chart is showing is the total number of ounces of gold purchased under Republican and Democrat administrations, and it goes back to the middle of the 1980s. And you can see pretty notable spikes or higher levels of demands when there's a Democrat in the White House. And in terms of breaking this down, in terms of average figures, in the 12 months that followed a Democrat winning, average purchases came to about 80,000 ounces a month. When a Republican was in office, it was closer to only 30,000. So I think the anecdotal data suggests that if a Democrat wins the White House, the Republican voters get scared that something bad's going to happen, so they all go in and pile into gold. Whereas if there's actually a Republican in the White House, maybe they're not as worried about who's got their hands on the economic and economic levers. So anyway, if this is any guide, then any of us in the bullion industry should probably want Kamala to win. But that's obviously a personal choice for everybody. Moving on to politics and onto something less controversial is the outlook for policy. So obviously, just last week, Jerome Powell spoke at Jackson Hole. It's basically a lay down misere now that rates will be cut, likely in a few weeks. So we're very, very likely, only a few weeks away from the beginning of a monetary easing cycle. And what was really interesting was a couple of weeks ago, Bank of America, they had a survey. It wasn't about where rates will go necessarily, but it was just a survey of fund managers and their answer to the question, is monetary policy, not only in the United States, but basically around the developed world, whether it's too restrictive or not. And this chart that you can see at the top there goes all the way back to 2000. And you can see that where we were in August 24 was basically the highest point since October 08. And there's sort of 4 key points here on the chart where basically as a collective, the funds management community has gone, geez, policy is tight, we need easing to come. The table that you can see at the bottom here shows the average 1-year return for gold and for silver, and the average 3-year return for gold and silver in the periods that followed April 01, October 08, and March 2020. So obviously no guarantee of what will happen moving forward, but if history is any guide, the move to monetary easing, which as I say is almost certain to start in a couple of weeks, is likely to be a very substantial tailwind for both gold and silver in the 2 or 3 years ahead of us. So I think that's one of the reasons why we're starting to see people add gold and silver to their portfolios at a stronger rate. People can sort of sense that the change is coming, and quite sensibly they want to get ahead of that. And that sort of leads on to, I think, one of the last points before I'll turn over to questions that I wanted to talk about. And this is really around, I think probably one of the perhaps less appreciated drivers of gold, but I think really one of the most important. So most people obviously understand that gold's an inflation hedge. Most people, love it for its tangibility, its liquidity, all of those things. But one of the things that really tends to see gold move is its outperformance when equity markets fall away substantially. Now, back in about 2015, a group called AQR, sort of quant traders, very sophisticated guys in the United States, they wrote a research paper that looked at the largest quarterly declines in global equity markets from the 1970s onwards, which was kind of convenient because that coincided with the end of the gold standard. And what they looked at was, well, what are the things investors can do to protect capital in environments where equities fall? And they looked at what bonds did. They looked at what a sort of amalgamation of hedge funds had done. They looked at what some very clever trading strategies that would be very difficult for average investors to implement. They looked at all of these things, and they also threw gold in as one of the assets to compare to. And gold was better than everything. So there was a lot of these, quite sophisticated, as I say, trading strategies, things that would probably only be available to institutional investors, maybe family offices, you name it, with really deep pools of capital and ability to access that expertise. Even that wasn't as good as just simply going and buying a gold bar, right? So there is absolutely no doubt that gold has got this really unimpeachable track record as a hedge against equity market risk when that equity market risk proves to be sustained. And with the help of our fabulous marketing team, we actually whipped up this chart here last year, and we looked at the Australian market. So basically using the same logic behind that AQR research, but we said, let's go and look at what is the average return for the equity market in the months that it falls, right? Obviously it doesn't fall every month, but when it does, what happens? Well, on average it falls 3.6%. In those months, gold has on average gone up by 1. In the quarters where the equity market's fallen, on average it's fallen by nearly 7, and you can see the gold price has gone up by just over 3 in those environments. And if you look at the calendar years, or the rolling 12-month periods, I should say, where the equity market's down, the average return has been close to minus 13%, and gold has been up 15 in those years. So it doesn't matter whether you're talking global equities, US equities, any particular jurisdiction, and definitely Australia as well, gold has this performance, or has this history of outperforming when equity markets run into some trouble. And I think that's going to be really important and probably going to be one of the main drivers in the years to come, for the very simple reason that much like in the year 2000, equity markets are at absolutely nosebleed levels. So last chart of the day, I promise, apologies for all of them, but I will spend a couple of minutes talking through this just to explain what it shows. It's actually not a chart about gold at all, it's just about the equity market. So I'll just spend a minute. I'm sure a lot of people in the room already know what a price-earnings ratio is, but for those that aren't, just please bear with me for 60 seconds. So let's assume you've got a company that is trading at $100 per share on the ASX, and the earnings of that company every year equate to $10 per share. Well, very simply, you've got a price, $100, earnings 10, your price to earnings ratio is 10, right? Now, there's multiple ways you can look at the earnings of a company. You could say, well, let's just look at what they earned last year. There'll be people that will say, but they're growing. Let's look at what their forecast earnings are for next year, right? And let's base this price earnings ratio on that. Or you could say, hey, companies have good years, they have bad years. Let's take, say, the last 10 years as a whole, because that gives us a better insight into what earnings are over a market cycle, right? So this chart, the red line that you're looking at on the chart, the gold line on the chart, is called the cyclically adjusted price earnings ratio for the entire market, the entire US equity market, and it goes back to the 1970s, right? So on the left-hand scale, you can see it goes up as high as sort of 60 and all the way down to 0. So if we start at 1970 and we're at this point here, what it's showing is that back in 1970, if you took the market as a whole, investors were willing to pay 20 times company earnings to own stock at that time. And obviously, markets move through cycles of fear and greed. And so there are periods where investors don't want to pay very much for earnings at all. And there are other periods where they're willing to pay, frankly, ludicrous prices. So if you look at what happened in the 1970s, you can see that investors started to get pretty fearful. And so the ratio dropped. Then we went through this amazing 20-year bull market. We ended up at a point here where investors were paying nearly 50 times earnings to buy shares, which is another way of saying that in the year 2000, investors were basically paying for all the money that companies were going to make up until about 2048. That's how bullish they were on buying stock at the time. Obviously, that coincided with a huge crash, so on and so forth. You can see where we are now, that we're basically, so you've got to go back over to this side, so we're basically almost back at 40, right? So we're at a point where equities are, they've only been more expensive twice. Once back in the year 2000, and then basically a couple of years ago in the aftermath of all that stimulus coming into the market after COVID hit that also caused a huge spike in the market. Now, the red line, and the reason I wanted to include it, also shows what was the subsequent 5-year return if you'd owned stock at this point. So again, if we use 1970 as a starting point, right, where we say roughly 20 times earnings, well, what the red line's showing then is what was the return if you held until 1975, right? So basically 5 years forward. And it's pretty clear what happens. Like the most obvious example is here. If you are paying 40 times earnings to own stock, you are probably going to get absolutely clobbered in the 5 years that comes, right? Because the market just cannot keep paying higher prices for company earnings, right? Perversely, if you look here in 1980, which is basically the lowest point on the series, so at this point, everyone was bearish on stocks. No one wanted to buy, right? So you could buy the entire market at roughly 10 times earnings, right? And what happened? At that exact point, if you'd have held for 5 years, you made over 200%, right? So the market is telling us very clearly now, or history is telling us, I should say, that as a whole, there are obviously going to be exceptional stocks, but for the market as a whole, investors are paying what has historically been an extremely high price for company earnings today. And that the market also shows us that historically, as an aggregate, that leads to very poor outcomes in the subsequent 5 years that follows. And so again, if you sort of think back to this previous chart, if you are of a view that equity markets might take a pretty meaningful hit in the next few years as a whole, then logic would suggest and history would suggest that gold is going to be one of the best assets you can own to not only maintain but actually increase your overall portfolio in that environment. And so whilst I think that it's natural, given all of the noise around the upcoming election and given our natural interest in what will happen with interest rates as they relate to gold, whilst those are the things that are very topical right now, I actually think that this will be the more important driver of gold price or gold demand and potentially gold performance in the 2 to 3 years that follow on from today. So I think I've got a few minutes left. That was the end of my formal presentation. So thank you so much for your time, guys. Cheers.